Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be doing a comparison between IV rank and IV percentile, which are both very popular metrics or indicators that are often used by option sellers like myself on a day-to-day basis when trading options. And as you will see in this video, IV rank and IV percentile are both very similar to each other in many ways, but there are a few key subtle differences that can potentially make one better over the other. But if you ask me, I personally like to use both at the same time, so make sure to stick around for the full video so you understand why. And if this stuff sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. I would greatly appreciate it. And so, as usual, before getting started here, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE. I've been teaching on that platform for well over a year at this point, and in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data with spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses, but if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE absolutely for free. And then once your trial has ended, it will only cost you a few dollars a month to maintain your membership, and you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on SKILLSHARE too. And if you decide it's not for you, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump over to my trading platform now and we'll get things started. Okay, welcome to my trading platform here, and as usual, I have a chart already pulled up, and this time it is a 1-year price action chart of Apple. But for the purpose of this video, we're going to focus mostly on this chart down here. Right, this graph is showing you the implied volatility for Apple over the past 1 year as well. And I assume if you're watching this video, you probably already have a good idea of what implied volatility is. But just in case you don't, implied volatility is simply the market's expectation of where a stock, in this case Apple, will be at some point in the future. It basically gives you an expected range of price movement at, like I said, some point in the future. So looking at this implied volatility graph down here, you can see as of right now, the current level of implied volatility for Apple is right around 43%. And implied volatility, when you look it up in your platform, is typically going to be quoted on a 1-year basis or a 1-year projection. So this means that 1 year from today, the market is currently expecting Apple stock to be either up or down by about 43%. So that's all implied volatility is, and as you can see, the levels of implied volatility can definitely fluctuate over time, depending on what's happening in the market, what's happening in the world, and of course what's happening with Apple as a company. The market's expectation of where Apple stock will be in the future can definitely change. And so if you are an option seller like myself, or if you are learning about option selling, then implied volatility is going to be your #1 indicator to look at to help you determine if you should or should not make a trade. And that's because, of course, implied volatility has a direct impact on the prices of options. As implied volatility expands, that's going to increase the prices of options. And then conversely, as implied volatility contracts, that's going to decrease the prices of options. And so as an option seller, or as a seller of anything, you always want to sell your product at the highest price possible. So in the case of options here, if the prices of options are going to expand when implied volatility increases, then it's going to be moments like this where you have a spike of implied volatility and therefore a spike in option prices. It's at these points where you want to be selling options, because every time implied volatility expands significantly like this, it will always at some point thereafter contract. And that will of course decrease the value of the options you sold. So ultimately, if you sell options here when the prices are very high and you buy them back down here when the prices have dropped significantly, you can make the difference in prices as your profit. And so now tying in IV rank and IV percentile, these two metrics simply give you a gauge on how elevated or how deflated implied volatility is at the moment. and they both use historical or past implied volatility levels to tell you that. So looking at IV rank first, this indicator will tell you where the current level of implied volatility is situated between the highest point and the lowest point in the past year. So just looking at this graph here, over the past 1 year, the highest point that implied volatility for Apple got was right here, back in March of 2020, and this was when the market was crashing because of the coronavirus pandemic. And so at this point, implied volatility got up to right around 100%, which when you think about it is a pretty massive number, right? Because this means at this point in time, 1 year from this point, the market was expecting the possibility of Apple being down by 100%, basically going bankrupt. So definitely a very extreme point in time here. And then the lowest point implied volatility got to over the past 1 year was right here, around early June of 2020. And implied volatility at this point got down to right around 26.6%. So if the high was 100% and the low was, rounding up, just call it 27%, then the current level of implied volatility, 43%, is definitely on the lower end in between the high and the low. And so that's why the IV rank here is only 21%, right? This number will always be between 0 and 100. 0 meaning that the current level of implied volatility is actually the low of the year, and then 100% meaning the current levels of implied volatility are actually the highs of the past 1 year. So like I said, with IV being right around 43% currently, an IV rank of 21% is definitely showing you, at least based on this indicator alone, that the implied volatility is definitely on the lower end. So just by this indicator by itself, this would not be showing you a very advantageous situation to be selling options. You would want to wait for an IV rank typically much higher than just 21%. I, for example, like to look for an IV rank above 50, although as I will explain here in a minute, because of this huge spike in implied volatility last year, the IV rank is going to be distorted until this moment of time eventually rolls off. And so that's why, as of right now at least, with this particular data still being factored into the past 1 year of implied volatility, that's why as of right now at least, I will still be open to selling options if the IV rank is as low as 20, but only if the IV percentile is above 50. And so now let's talk about what IV percentile is. And just like IV rank, it is simply another way of gauging how elevated implied volatility is right now at the moment compared to the past. Except the major difference here is that it does not care only about the high and the low over the past 1 year. It actually cares about every single day over the past 1 year. So IV percentile now will show you, and you can obviously just read this part and it will pretty much tell you exactly what IV percentile is. So it essentially just tells you how many days over the past 1 year had implied volatility levels that were less than the current level right now. So with an IV percentile of 52%, that means, again, over the past 1 year, 52% of those days had implied volatilities of less than 43%. And that's because recently, we've definitely had a bit of a spike that's been occurring in implied volatility for Apple and also across the entire market. So looking at this horizontal line right now, that is right at the current levels of implied volatility, and then going back across time here, you can definitely see just by looking at this chart visually that, yeah, about half the days of the past year were below this horizontal line. So that's what IV rank is, and that's what IV percentile is. Now, if you had to choose one over the other, which one would I recommend you choose? Now, I know I said at the beginning of this video that I personally like to use both at the same time, and I'll explain why here in a minute, but if I just had to choose one, I would choose IV percentile, not IV rank. And that's because, like I mentioned a few seconds ago, IV rank does have the tendency to be distorted if there are significantly large spikes of implied volatility over the past 1 year. And I'm talking spikes that are basically historic, right? When the market crashed by over 30% back in February and March of 2020, the implied volatility across the entire market hit near record-breaking levels. There have only been a very small handful of moments in the entire history of the stock market where the implied volatility got to this point. This kind of thing happens usually only once every 10 or 15 years or so definitely very infrequent. But like I said, this kind of event will distort the IV rank for the next year until this data rolls off. And that's because if the IV rank only cares about the highest point that IV got to in the past year and the lowest point, well, that means if the highest point was at record-breaking levels, then of course once implied volatility comes down from that point, the chance that it's ever going to get even close to that high again over the next year is basically zero, right? Like I said, this kind of thing usually only happens once every 10 or 15 years, not every year. And you can definitely see that over the course of this past year, implied volatility definitely did expand multiple times, but it never got anywhere close to 100%. The highest point I got since then was only right around 63%. And so of course, if IV rank is measuring where implied volatility is now relative to the high and the low over the past year, then of course, as long as this data is still within the past year, then the IV rank is always going to be on the lower end. And like I said, generally speaking, I prefer to look for an IV rank above 50% to give me a signal when I should be selling options. I think at this point right here, this little bit of the graph that's still green, this was the one other point in time over the past year that the IV rank actually hit 50. So basically like 2 or 3 days over the past 1 year. So if you were only looking at IV rank, then after March of 2020, you pretty much only would have been shown an opportunity to trade Apple one other time. And that's a definite shame because there are many times over the past year where implied volatility still definitely spiked by a significant amount and made for great trading opportunities. So ultimately here, because IV rank can get distorted, which obviously does not happen very often, because this kind of thing does not happen very often, I would say because of that fact, if I did have to choose one over the other, I would choose IV percentile, right? Because this one simply shows you how many days over the past 1 year were less in terms of the implied volatility than today's levels. And this huge crash back in March did not last for that long. It was only a few weeks. So if you were only looking at IV percentile, then this indicator alone would have showed you plenty of opportunities to trade Apple, right? Because just like IV rank, I also like to look for an IV percentile above 50%. And if right now the IV levels are above 50%, then now looking above this horizontal line right here, there were many times over the past year where Apple's implied volatility exceeded 50% in terms of the percentile. And again, just to reiterate here, the reason why you want to look for implied volatility above 50% either for IV rank or for IV percentile is due to the fact that implied volatility, once it spikes, once it gets above 50%, you will always see at some point pretty soon thereafter, I would definitely say sooner rather than later, you will always see a contraction. And that will allow you to sell options at high prices and then buy them back at much lower prices. And that can happen completely independent of where the stock is actually moving. Of course, if the stock does directionally move in your favor at the same time, that will improve your profits further. But of course, even if the stock just goes nowhere and implied volatility is contracting, that alone will allow you to buy back those options at cheaper prices and walk away with profits. It's a very cool thing. And so now lastly here, touching on why I prefer to use both of these indicators at the same time, and it mostly has to do with the thinkorswim trading platform that I personally use on a day-to-day basis. Specifically, when you go into the Market Watch tab here and you go into your watch list, you will have the ability to add a column here for each one of the stocks in your list for the IV percentile, right? So this column here just shows you for each one of these stocks what the current IV percentile is at the moment. The exception though is that this is not actually the IV percentile. This is a bug. These numbers that you see here, these are actually the IV ranks of each of these stocks. So this column here is misnamed. It is IV rank, not IV percentile. And I can prove this by sorting the list here alphabetically. And so you can see for Apple here, going over to the IV percentile, it says it's 21.26%. But in reality, coming back to the charts now, the IV rank is 21%, not the IV percentile. The IV percentile is actually 52%. So like I said, that column is misnamed. And unfortunately, I don't believe there is another metric or column you can add here that will actually show you the real IV percentile for these stocks. And so for me, when I'm searching through my watch list here every morning looking for a trade, I will always sort the list by the IV rank from highest to lowest, just like this here. And I will simply walk myself down this list trying to find the appropriate trade I need for my portfolio. But since the IV rank can definitely get distorted, as you've just seen, that means you will not see Apple anywhere near the top of this list. And that's because the IV rank is actually all the way down here in the low 20s. You can see Apple right here. And so if you were only looking at IV rank, and generally speaking you should be looking for stocks with an IV rank above 50, then there's no way you would ever consider trading Apple. The IV rank is way too low. But because IV ranks are distorted right now, I will still look at all the stocks and ETFs with IV ranks above 20. And so if I were scanning this list here and I came to Apple, I would see the IV rank, it's above 20, okay. Let me go to the charts and take a look at the Iv percentile now. And if the Iv percentile is above 50, then I will still consider this stock a possible trading opportunity. Looking at this chart right here, there has definitely been a pretty significant spike in implied volatility. It definitely could go higher, but once the Iv percentile gets above 50, you have a greater chance of implied volatility contracting than expanding further. So that's why at this point I would still consider selling options on Apple to try and take advantage of a likely contraction of implied volatility at some point in the near future. But ultimately, you really cannot go wrong using one over the other, and that's because the vast majority of the time the IV ranks will not be distorted. So if you do decide to just pick one and stick with that, I would say that's totally fine. They are both very similar anyways. But if you are going to pick IV rank, then just keep in mind the next time we have a very significant market correction, and if implied volatility during that time hits near record levels, then for the next year following that point, you're going to want to adjust your standard for IV rank and lower it from around 50 down to maybe around 20. Alright, so that concludes this video. I hope you enjoyed it, and let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.